If you want to understand why so many people feel like they're working harder than ever, but somehow still not getting ahead, you don't need motivation quotes, you need numbers. Because once you look at the actual money stats behind the average person in 2026, a very different picture starts to show up. And honestly, some of these are wild. So today we're going through 10 jaw-dropping money stats of the average person in 2026. From income to debt to savings to the uncomfortable gap between looking stable and actually being stable. And if you watch all the way through, you'll see why financial progress today is less about earning more in a straight line and more about avoiding the traps that quietly drain people for years. Let's start with number 10. Number 10. The median household income is $83,730. On paper, that sounds decent, and for a lot of people watching this, that number might even sound pretty high. But here's the problem. Income by itself doesn't tell you whether someone is actually building wealth. It just tells you how much money is coming in before life starts taking a cut. Housing takes a cut. Insurance takes a cut. Taxes take a cut. Groceries take a cut. Cars take a cut. Debt takes a cut. So even though the median household income in the US was reported at $83,730, a lot of households still feel financially squeezed. Number 9, median weekly earnings for full-time workers are $1,235. That's the typical weekly paycheck for full-time wage and salary workers in early 2026. Again, not terrible at first glance, but when people hear numbers like this, they usually imagine a smooth financial life. The reality is different. A paycheck can look normal and still be completely overwhelmed by normal-looking expenses. That's why so many people can be employed, working consistently, and still feel one bad month away from a problem. Number 8. Women's median weekly earnings are $1,098 compared with $1,362 for men. That means women earned about 80.6% of men's median weekly earnings in the latest BLS release. And regardless of where someone stands politically, financially, this matters. Because over time, even a smaller weekly gap becomes a larger long-term gap in investing, emergency savings, retirement balances, and financial flexibility. People don't just live on income. They live on what income becomes after years of compounding or years of falling behind. Number 7, 63% of adults say they could cover a $400 emergency with cash or its equivalent. Now, at first, you might think that sounds encouraging, but flip that around. If 63% can, then 37% cannot. More than 1 out of every 3 adults would struggle to absorb a relatively small surprise without borrowing, carrying a balance, selling something, or missing another bill. And that's what makes this stat so powerful. It's not about the $400, it's about how thin the margin is. Number 6, only 55% of adults have at least 3 months of emergency savings. That means 45% do not have a basic financial buffer. Not 6 months, not 1 year, just 3 months. This is the difference between inconvenience and crisis. Because when someone has no cash cushion, every financial decision becomes urgent. And urgency is expensive. It leads to bad credit choices, rushed decisions, penalties, and panic. Number 5, total household debt in the US has reached $18.8 trillion. That is not a typo. $18.8 trillion in household debt. This is the broad backdrop behind everyday money stress in 2026. When people talk about the economy, this is part of what they mean on the ground level. It's not some abstract headline. It's mortgages, credit cards, student loans, auto loans, and everything else sitting on top of a paycheck that already has to stretch far enough. Number 4, mortgage debt alone is $13.19 trillion, by far the biggest category. And that makes sense because housing is usually the largest expense most people ever take on. But the real takeaway here is that for the average person, housing doesn't just affect the monthly budget. It shapes the entire financial timeline. Where someone lives affects savings rate, commute cost, insurance cost, property taxes, flexibility, career choices, family planning, and even whether they can invest consistently at all. Number 3, credit card balances are now $1.25 trillion. This is one of the most dangerous numbers on the list because credit card debt often grows silently. It doesn't always start with reckless spending. Sometimes it starts with groceries, car repairs, medical costs, travel for family emergencies, a month of expenses that hit at the wrong time. And once revolving debt kicks in, the interest starts doing what investing is supposed to do for you, except now it's working against you. Number 2, auto loans have climbed to $1.69 trillion, and student loans stand at $1.66 trillion. Think about what that means. Before some people even begin building meaningful wealth, they're already carrying major obligations tied to transportation and education. 2 things that are supposed to improve life can become long-term monthly anchors if the math doesn't work out. And this is why so many people feel stuck even when they're making responsible choices. Responsible doesn't always mean affordable. And finally, number 1, 4.8% of outstanding household debt is already in some stage of delinquency. That means millions of balances are not being paid on time. And behind that number are real households trying to manage rising costs, fixed payments, and little room for error. On top of that, student loan delinquency remains elevated, and mortgage transitions into serious delinquency have ticked up slightly. So when people say consumers are under pressure, this is what pressure looks like in numbers. Now here's the bigger lesson. The average person in 2026 is not necessarily broke. They're not necessarily irresponsible. And they're definitely not always lazy. More often, they're financially exposed. They may have income, but not enough slack. They may have assets, but not enough liquidity. They may look stable from the outside, but one setback can still create a chain reaction. That's why the goal isn't to look rich. The goal is to become hard to financially damage. That means keeping fixed expenses lower than your ego wants, building emergency savings before chasing lifestyle upgrades, treating high-interest debt like a fire, avoiding car payments that eat your investing power, and increasing your gap between what you earn and what you need, because that gap is where freedom lives. If there's one thing these stats show, it's this. The average person's biggest money problem isn't always low income. It's low margin. And once your margin disappears, everything feels harder than it should. So if you want an advantage in 2026, don't just focus on earning more. Focus on becoming less fragile. Build cash. Control debt. Keep your lifestyle flexible. And make sure your money can survive a bad month, not just a good one. Because the people who win financially are not always the ones who look the richest. Usually they're the ones who quietly built enough breathing room that life stopped controlling every decision they make. And in this economy, that might be the most underrated flex of all. What does the average person's financial life actually look like in 2026? Not the version people post online, not the version that shows up in filtered vacation photos, new car delivery videos, or productivity reels about waking up at 5 a.m. I'm talking about the real version, the one hidden behind bank balances, paycheck sizes, emergency savings, and debt payments. Because when you strip away appearances and just look at the numbers, the average person's money situation is way more fragile than most people think. So in this video, let's break down 10 jaw-dropping money stats of the average person in 2026. And by the end, you'll understand why looking financially okay and actually being financially secure are two completely different things. Number 10. The median household income is $83,730. That's the benchmark a lot of people will use to judge whether someone is doing fine. But income is one of the most misleading money stats if you look at it by itself. Because a decent income can still be paired with high rent, expensive debt, weak savings, and almost no investing. In other words, a household can earn a respectable amount and still be under serious financial pressure. Number 9, the median full-time worker earns $1,235 per week. This is where the average worker lives. Not in fantasy money, not in millionaire money, but in a paycheck world where every month has to be managed carefully. And if you multiply that out mentally, you realize how easy it is for everyday costs to start consuming almost all of it. A lot of people don't have a spending problem. They have a margin problem. There's just not enough left over after the basics. Number 8, women earn $1,098 weekly at the median, while men earn $1,362. That puts women at 80.6% of men's median weekly earnings. And again, this isn't just a labor market talking point, it's a wealth building talking point. Smaller cash flow means smaller investing capacity, smaller emergency buffers, and often slower recovery from setbacks. A weekly income gap doesn't stay weekly. Over time, it becomes a net worth gap. Number 7, 63% of adults say they could cover a $400 emergency with cash. That sounds okay until you look at what it really means. 37% of adults couldn't. That's more than 1/3 of people being vulnerable to a relatively small financial shock. And when people can't handle a basic emergency with cash, they don't just face the original problem. They often face the financing cost of the problem too. Number 6, only 55% of adults have 3 months of emergency savings. Which means 45% do not. That's the part that should stop people in their tracks. Almost half of adults don't have what most financial advisors would call a minimum stability buffer. That means job loss, income interruption, or even a large repair bill can hit harder than it should. Emergency savings is not just money sitting around doing nothing. It's insurance against desperation. Number 5, household debt in America is now $18.8 trillion. This is the environment the average person is operating in. When debt gets this large, it doesn't just affect individual budgets, it affects the entire tone of the consumer economy. People become more payment dependent, less flexible, and more sensitive to rates, fees, and income interruptions. Debt creates obligations, and obligations reduce options. Number 4, mortgage debt alone totals $13.19 trillion. Housing remains the dominant financial commitment for most households. And here's the important point. Housing cost is not just about whether you can afford the payment. It's about what the payment prevents you from doing. Can you invest? Can you save? Can you change jobs? Can you relocate? Can you survive one income disappearing? The average person often discovers too late that the true cost of housing is lost flexibility. Number 3, credit card balances have reached $1.25 trillion. This is one of the clearest warning signs in personal finance, because credit cards can create the illusion of stability while quietly eroding the future. They help you maintain the lifestyle today, then charge you tomorrow for pretending everything was fine, and once interest gets involved, time stops helping you and starts hurting you. Number 2, auto loan balances are $1.69 trillion and student loans are $1.66 trillion. This is the modern middle-class squeeze in one sentence. People borrow to move, people borrow to learn, and then those payments follow them for years. The car gets older, the degree gets older, but the monthly obligation stays fresh, and that makes it harder to save, harder to invest, and harder to build momentum. Number 1, 4.8% of all outstanding debt is in some stage of delinquency. This is where the polished version of the economy starts to crack. Because delinquency means some borrowers are no longer keeping up, and that matters even if you personally pay every bill on time, because it tells you something important about the stress level inside the system. It also matters that student loan delinquency remains elevated, and mortgage transitions into serious delinquency have edged higher. Pressure is showing up. So what do all these stats tell us? They tell us the average person in 2026 is walking a financial tightrope. They may be earning, they may be spending responsibly, they may even be doing everything society told them to do, but they still might not have enough cushion. That's the real story. Not poverty versus wealth, not success versus failure. Cushion versus no cushion. The financially strong person is not always the highest earner. Sometimes it's the person with the lowest fixed costs, the healthiest savings, the least toxic debt, and the most room to absorb bad luck without going backward. That's why the game in 2026 is not just income maximization. It's resilience maximization. Can you survive a surprise expense? Can you go 3 months without panic? Can you avoid turning everyday problems into high-interest debt? Can your lifestyle keep running if one piece breaks? Those questions matter more than appearances, because a lot of people are one inconvenience away from calling it a crisis. And if you want to avoid becoming average in the worst financial sense, here's the practical move. Build a boring financial life that is stronger than it looks. Keep expenses lower than your income suggests you can afford. Don't normalize monthly debt as a permanent lifestyle feature. Save cash first, invest consistently second, upgrade slowly, and make sure your freedom grows faster than your bills. The truth is, wealth is not just about having more. It's about needing less pressure to stay okay. And that's what these 10 money stats really reveal. The average person in 2026 doesn't just need more money, they need more breathing room. If you can build that before everyone else figures it out, you're already ahead. If I had to describe the average person's financial life in 2026 with one phrase, it would be this: expensive to maintain, but easy to disrupt. Because from the outside, a lot of people look normal, they have a job, they pay rent or a mortgage, they own a car, they buy groceries, they keep the lights on, maybe they even go on vacation once in a while. But then you look at the numbers and suddenly normal starts to look incredibly fragile. So today we're counting down 10 jaw-dropping money stats of the average person in 2026. These are the numbers that explain why so many households feel stretched, why so many workers feel stuck, and why financial peace has become a lot rarer than financial appearances. Let's get into it. Number 10, the median household income is $83,730. Most people hear that and assume the average household should be comfortable. But comfort depends on what happens after the money arrives. And in 2026, that's where things get messy. Earning money is one thing. Keeping enough of it after housing, insurance, food, transportation, taxes, and debt payments is something else entirely. So yes, income matters, but income without margin is just motion. Number 9, the median full-time worker earns $1,235 a week. This is the heartbeat of the average paycheck economy. It's enough to keep life moving, but often not enough to create real separation from risk. That's why a lot of workers feel like they're always resetting every month. The paycheck arrives, obligations take their share, and the opportunity to actually build something for the future gets squeezed into whatever is left, if anything is left. Number 8, women's median weekly earnings are $1,098, while men's are $1,362. That means women are earning 80.6% of men's weekly median earnings in the latest data. Now forget politics for a second and just look at the math. Different cash flow changes every downstream financial outcome: savings rate, debt payoff speed, investment contributions, retirement growth, and how quickly someone can recover from an emergency. A money gap today becomes a flexibility gap tomorrow. Number 7, 63% of adults say they could cover a $400 emergency expense with cash or cash equivalent. At first glance, that seems solid, but the more revealing stat is the one hiding inside it. 37% of adults could not. More than 1 in 3 people would have trouble handling a relatively small emergency out of pocket. That tells you something important. The average person is not always collapsing because of giant disasters. Sometimes it's the smaller hits that do the damage because there wasn't enough reserve to begin with. Number 6, only 55% of adults have at least 3 months of emergency savings. So nearly half of adults don't have a basic cushion, not a luxury cushion, not retire early money, just a buffer. And if you've ever wondered why job loss, illness, or one interrupted paycheck can cause such severe stress, this is why. Emergency funds don't just protect money, they protect decision making. Without them, people are forced into short-term thinking exactly when they most need long-term judgment. Number 5, U.S. household debt has climbed to $18.8 trillion. That number is massive, but what makes it meaningful is how personal it becomes. Debt is future income already spoken for. It's tomorrow's flexibility being used to solve yesterday's needs. And when that amount gets this large across households, it suggests that a lot of people are living with less room to maneuver than they appear to have. Number 4, mortgage debt is $13.19 trillion. Housing remains the giant. It dominates budgets, shapes location decisions, and determines how much financial oxygen households have left over. The issue isn't that people buy homes or pay for housing. The issue is that when housing becomes too large a share of total financial life, almost every other goal slows down. Saving slows down, investing slows down, risk tolerance disappears, and life gets more expensive to change. Number 3, credit card balances now stand at $1.25 trillion. This is where financial pressure becomes dangerous. Credit cards can help people bridge shortfalls, but they can also trap people in a cycle where the payment never seems to meaningfully reduce the balance. That's the trap. Borrowing to protect the present while weakening the future. It feels manageable at first because the minimum payment seems small, but over time it quietly turns ordinary spending into long-term drag. Number 2, auto loan balances are at $1.69 trillion, while student loan balances are $1.66 trillion. That means transportation and education, 2 things many people see as necessary, are carrying almost equal trillion-dollar burdens. Think about how powerful that is. Before someone even tries to get ahead, they may already be financing the way they get to work and the degree that was supposed to improve their earning potential. Those monthly payments don't just cost money, they crowd out opportunity. And now for the most important stat on the list. Number 1, 4.8% of outstanding debt is in some stage of delinquency. That number tells you the stress is real. Some households are no longer keeping up, and when delinquency rises or remains elevated, that's usually the visible symptom of something deeper. Thin savings, high fixed costs, unstable cash flow, or too much debt stacked on too little breathing room. It's also notable that student loan delinquency remains elevated and mortgage transitions into serious delinquency have risen slightly. So pressure isn't theoretical, it's measurable. Now step back and look at the full picture. The average person in 2026 earns money, but not always enough margin. The average person spends money, but often under pressure. The average person borrows money, sometimes just to stay in place. And the average person saves money, but not always enough to survive disruption comfortably. That doesn't mean the average person is careless. It means the system rewards appearances faster than resilience. It rewards the nicer apartment before the larger emergency fund. The newer car before the lower monthly obligation, the lifestyle upgrade before the investment contribution, the I deserve this purchase before the I need stability plan. And that's why the people who quietly win with money often look boring for a long time. They build cash first, they keep fixed costs controlled, they avoid high interest debt, they leave space in the budget, they buy themselves options, because options are what debt takes away. So if you want the real takeaway from these 10 jaw-dropping money stats, it's this. The average person's financial problem in 2026 is not always a lack of effort. It's a lack of shock absorption. And the solution is not just to earn more. The solution is to become harder to knock over. Save before you show off. Lower obligations before you upgrade. Protect cash flow before you chase status. And build a life that can survive a surprise. Because in a world where average finances are this tight, resilience is the new luxury.